The world's financial engineers spent decades convincing markets that sovereign debt could expand forever, that bond auctions would always clear, that central banks held infinite credibility. But right now, in the quiet corners of Japanese bond markets, in the trembling hands of UK pension managers, in the spreadsheets of Treasury dealers staring at auction coverage ratios, something is breaking. Not with headlines, not with panic, but with the cold, mechanical precision of mathematics finally demanding its due. $315 trillion in global debt is about to discover what happens when the market stops pretending. And gold and silver, they already know. Welcome to John Analyst, where we cut through the noise and deliver the financial intelligence that actually matters to your wealth, your business, and your future. Now, before we dive deep into what's unfolding in these debt markets, I need to ask you something important. If you're someone who values clarity over hype, if you've built something real in this world and refuse to be blindsided by what's coming, then do me a favor, hit that subscribe button. Not for me, but for yourself. Because the signals we're tracking don't wait for permission, and neither should your preparation. And while you're at it, drop a quick comment and tell me, where in the world are you watching this from? Are you watching from London, New York, Dubai, Singapore? Let me know, because what's coming doesn't respect borders, and I want to know where the smartest people in the room are positioned. Now, let's talk about what the bond market is quietly screaming. The most dangerous financial crises don't announce themselves with sirens. They whisper through bond yields that most people never watch, through auction results buried in financial footnotes, through subtle shifts in markets so boring that even seasoned investors ignore them until it's far too late. Right now, that whisper is getting louder. Across the developed world, from Tokyo to London, from Washington to Berlin, sovereign debt markets are sending a signal that hasn't been this clear since the 2008 financial crisis. But this time, the crisis isn't hidden in mortgage-backed securities or bank balance sheets. This time, it's hiding in plain sight. The global debt burden has reached $315 trillion. That's not a projection. That's not a worst-case scenario. That's the actual number right now, today. And here's what most analysts won't tell you. That number represents 340% of global GDP. Let that sink in. The entire world economy would need to dedicate more than 3 years of total production, every factory, every service, every transaction, just to pay off the debt that already exists. And it's growing faster than the economy that's supposed to service it. But debt itself isn't the crisis. Debt becomes a crisis when the people lending the money start questioning whether they'll be repaid, and more importantly, whether the currency they'll be repaid in will hold its value. That questioning has begun. In Japan, the world's third largest economy and one of the most indebted nations on earth, something unprecedented is happening. The yield on 10-year Japanese government bonds recently breached levels that the Bank of Japan spent years trying to suppress. These aren't dramatic spikes. These are calculated, deliberate moves by institutional investors who are quietly stepping back from what was once considered the safest trade in Asia. Why does Japan matter to someone watching from New York or London or Dubai? Because Japan holds over $1.1 trillion in U.S. Treasury securities. Because Japanese institutions have been the silent backbone of global bond markets for decades. Because when Japan's domestic yields rise, those institutions have less reason to buy foreign debt, which means less demand for the bonds that finance American deficits. British spending, Canadian infrastructure. Less demand means higher yields. Higher yields mean higher borrowing costs. Higher borrowing costs mean governments face a choice: cut spending, raise taxes, or find another way to make the math work. History shows us which option they choose, but Japan isn't alone. The United Kingdom learned a brutal lesson in 2022 when bond yields spiked so violently that pension funds faced margin calls, forcing the Bank of England into emergency intervention. The crisis lasted weeks in the headlines, but the structural problem never went away. It just went quiet. Now it's stirring again. UK gilt yields are climbing, not catastrophically, not in a way that generates headlines, but enough that portfolio managers are recalculating duration risk, enough that insurance companies are hedging long-term liabilities differently, enough that the whisper is becoming a conversation. Across the Atlantic, the United States Treasury is issuing debt at a pace that would have been unthinkable 2 decades ago. The Congressional Budget Office projects deficits exceeding $2 trillion annually for the foreseeable future. And here's the critical detail most people miss. As existing debt matures, it must be refinanced at current interest rates. When that debt was issued at 2% yields, the interest burden was manageable. When it's refinanced at 4.5% or 5% yields, the interest expense alone consumes an ever larger share of tax revenue, which creates more deficits, which requires more borrowing, which puts more pressure on bond markets. This is the loop that doesn't have a comfortable exit. Germany, long considered the fortress of fiscal discipline in Europe, is watching its borrowing costs rise as political pressures mount to abandon austerity. The spreads between German bunds and peripheral European debt are widening again, a pattern that preceded every major European debt crisis of the past 15 years. These aren't isolated events. These are pressure points in a system that was built on assumptions that no longer hold. Assumptions like interest rates will stay low forever, central banks will always backstop bond markets, governments will eventually grow their way out of debt. Those assumptions are being tested in real time. And here's what makes this moment different from previous scares. The policy tools that worked before, quantitative easing, zero interest rates, aggressive fiscal stimulus, have already been deployed. Central banks are holding trillions in bonds they can't easily sell. Interest rates have risen, but remain below inflation in real terms. The ammunition has been spent. So when the next shock hits, when bond markets demand higher yields to compensate for rising risk, when auction coverage ratios deteriorate and dealers struggle to absorb supply, what happens then? Gold is trading above $2,900 per ounce. Silver is holding firm despite volatility. These aren't random moves. These are markets that understand something the headlines haven't caught up to yet. The foundation is cracking, and precious metals are responding to the tremors before the main event. Most people think financial contagion spreads like a virus. Chaotic, unpredictable, impossible to track until it's everywhere. They're wrong. Contagion spreads through plumbing, through the invisible pipes that connect Tokyo trading desks to London hedge funds, through the leverage structures that tie New York banks to Sydney pension managers, through the mathematical certainties that force selling in one market to trigger liquidation in another. And right now, those pipes are starting to rattle. Understanding how local debt stress becomes a global crisis isn't about fear. It's about mechanics. It's about recognizing that modern finance operates as an interconnected machine. And when one gear jams, the torque transfers to every other component in the system. There are three primary transmission channels, three pathways through which a bond market tremor in Japan can shake asset prices in Canada, through which a gilt crisis in London can force liquidation in Singapore, through which sovereign debt repricing anywhere can impact precious metals pricing everywhere. Let's start with the one that scared central banks so badly in August 2024 that they barely acknowledged it publicly. The carry trade unwind. Channel 1. The carry trade guillotined. For more than a decade, one of the most profitable trades in global finance was almost boringly simple. Borrow money in Japanese yen at near zero interest rates. Convert those yen into dollars or euros or any currency offering higher yields. Invest in higher yielding bonds, stocks, or real estate. Collect the spread. Repeat. The trade worked flawlessly. As long as two conditions remained stable, Japanese interest rates had to stay near zero, and the yen had to remain weak or stable, not strengthen dramatically. Estimates suggest more than $20 trillion in various carry trade structures were built on these assumptions. Hedge funds, pension funds, corporate treasuries, retail investors through structured products they didn't fully understand. The entire architecture rested on Japanese rates, staying suppressed forever. But forever ended when Japanese yields started rising, when the Bank of Japan signaled it could no longer maintain artificial suppression. The math on those trades flipped instantly. The funding cost increased, the yen strengthened as positions unwound. And here's the critical mechanism. When carry trades reverse, they don't unwind politely. Leverage forces immediate action. Margin calls don't negotiate. Algorithms don't pause for human consideration. Positions get liquidated across asset classes simultaneously, not because those assets are fundamentally broken, but because the machine demands cash. This is why in August 2024, gold dropped briefly despite no fundamental change in monetary outlook. Why the S&P 500 experienced sharp intraday swings. Why bond volatility spiked across multiple markets at once. It wasn't rational repricing, it was mechanical liquidation. And the carry trade that unwound partially in August, it rebuilt, quietly, slowly. Because as long as rate differentials exist, the temptation returns, which means the guillotine is still hanging, waiting for the next tremor to release it. Channel 2, the Great Reallocation. Japanese institutional investors, insurance companies, pension funds, government investment vehicles manage trillions in assets. For decades, they've been the world's most reliable buyers of foreign bonds, particularly U.S. Treasuries. Why? Because Japanese domestic yields were so low that investing abroad offered meaningfully better returns even after currency hedging costs. But that calculation is changing. When Japanese government bond yields were 0.2%, buying a U.S. Treasury yielding 3% made sense. When JGB yields rise to 1.5% or 2%, and currency hedging costs increase, and domestic regulatory pressure encourages home bias, the math tilts differently. Japanese institutions hold approximately $1.3 trillion in U.S. Treasury securities, They're not selling aggressively. They don't need to. They simply buy less on the margin. They let maturing bonds roll off without replacement. They allocate new capital domestically instead of abroad. This isn't drama. This is portfolio optimization. But the effect is profound. When one of the world's largest sources of Treasury demand steps back, even modestly, the US government still needs to sell the same amount of debt, which means other buyers must be found, which means yields must rise to attract those buyers. And it's not just Japan. European insurance companies under Solvency II regulations are recalculating long-duration bond holdings. UK pension funds are still scarred from 2022's liability-driven investment crisis. Canadian asset managers are questioning sovereign concentration risk. Everyone is asking the same question simultaneously. Do we really want to own 30-year government bonds at these yields in this fiscal environment with these political uncertainties? When everyone asks that question at once, term premiums reprice. Not because of panic, because of prudence. Channel 3. Fiscal dominance emerges. Here's the mechanism most analysts won't discuss openly because it challenges the fundamental narrative of central bank independence. Fiscal dominance occurs when a government's financing needs begin dictating monetary policy, rather than monetary policy operating independently to achieve price stability and full employment. It works like this. A government runs sustained large deficits. It issues massive amounts of debt. If interest rates rise too much, the interest expense on that debt becomes politically and economically unsustainable. So the central bank faces a choice: let rates rise and watch the government's budget implode, or suppress rates and accept higher inflation. When central banks choose to suppress rates below the level markets would naturally demand, when they implement yield curve control or restart quantitative easing despite elevated inflation, when they describe these actions as maintaining market functioning rather than monetizing debt, that's fiscal dominance. And once markets recognize that pattern, once investors understand that monetary policy will bend to fiscal necessity, the credibility of the currency itself comes into question. This is where precious metals enter the equation with mathematical precision. Gold and silver don't need conspiracy theories. They don't need apocalyptic predictions. They simply need investors to recognize that the real return on sovereign debt, the yield minus inflation minus currency debasement risk, is becoming negative when the safest assets in the traditional framework offer guaranteed erosion of purchasing power. Capital flows toward alternatives, toward assets with no counterparty risk, toward stores of value that can't be printed or digitally expanded by decree. The three channels, carry trade mechanics, institutional reallocation, and fiscal dominance signals, don't operate in isolation. They amplify each other. A carry trade unwind increases volatility. Increased volatility makes institutional investors more cautious. More cautious institutions demand higher yields. Higher yields stress government budgets. Stressed budgets pressure central banks toward fiscal dominance. Fiscal dominance raises currency debasement fears. Currency fears drive alternative asset demand. The loop feeds itself. And precious metals, historically derided as relics, are increasingly recognized as the only major asset class without embedded systemic leverage. Without counterparty dependency, without the need to trust that promises will be kept, the pipes are rattling, the pressure is building, and the markets that move first are the ones watching the gauges, not the headlines. There's a moment in every financial regime shift when certain assets begin moving in ways that defy conventional analysis. Analysts scramble for explanations. Pundits dismiss the moves as irrational. Retail investors wait for confirmation that never comes at reasonable prices. And the professionals, the sovereign wealth managers, the family offices that have preserved capital across centuries, they quietly accumulate. That moment is now. Gold is trading above $2,900 per ounce. Not because of a single headline, not because of geopolitical panic, not because some newsletter promised the end of the financial system. Gold is trading at record levels while simultaneously facing rising nominal interest rates, a condition that traditional textbook analysis says should be impossible. The textbooks are wrong, and understanding why they're wrong reveals everything about what's actually happening in the architecture of global finance, the signal hiding in plain sight. When gold rises despite higher interest rates, it's sending one very specific message. Real rates are not what they appear to be. And more critically, the market is pricing in future monetary debasement regardless of what current policy rhetoric suggests. Let's break this down with precision. Nominal interest rates measure the stated yield on bonds. Real interest rates subtract expected inflation. But there's a third component that traditional analysis ignores: regime risk, the probability that the rules governing monetary policy will fundamentally change, not through announcement, but through necessity. Gold doesn't trade on nominal rates. Gold trades on the certainty that holding fiat currency will preserve purchasing power over extended timeframes. When that certainty erodes, When the mathematics of debt servicing become impossible without monetary intervention, gold reprices not as a speculation, but as insurance against the inevitable policy response. And the policy response is already visible for those watching the right indicators. Central banks globally have purchased over 1,000 tons of gold annually since 2022. These are aren't retail investors reading apocalyptic blogs. These are the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, the National Bank of Poland, institutions with access to economic intelligence that never reaches public analysis. They're not buying gold because they're pessimistic. They're buying because they understand the math. They can see the same debt to GDP trajectories. They recognize the same fiscal constraints. They know what tools remain available when the next crisis hits. And those tools all involve expanding the monetary base. The institutional positioning shift. Sovereign wealth funds are quietly adjusting allocations. Norway's government pension fund, managing over $1.4 trillion, recently increased gold exposure. Singapore's GIC, one of the world's most sophisticated institutional investors, has signaled greater precious metals weighting in portfolio construction. These moves don't generate CNBC headlines. They happen in quarterly rebalancing reports buried in regulatory filings. But they represent something profound. The smartest institutional capital in the world is treating precious metals not as fringe alternatives, but as core portfolio components in a regime where traditional bonds no longer offer the risk-return profile they once did. The COMEX futures market is revealing stress patterns that sophisticated traders recognize immediately. Registered inventory, the portion of gold actually available for delivery, has declined substantially while open interest remains elevated. This creates a technical condition where physical demand could overwhelm paper contract settlement mechanisms. More telling, gold futures are trading in backwardation, meaning near-term contracts price higher than distant contracts. In commodity markets, backwardation signals immediate demand exceeding available supply. For a monetary metal like gold, persistent backwardation suggests something deeper. It suggests that holders of physical metal are less willing to part with it at any reasonable premium because they perceive the replacement cost in currency terms as uncertain. This isn't speculation. This is market structure speaking. Silver, the volatility amplifier. If gold is the steady hand, silver is the volatile accelerator. Silver occupies a unique position in the financial ecosystem. It's a monetary metal with thousands of years of history as currency. But it's also an industrial commodity, consumed in applications that cannot easily substitute away from it. Solar panel production requires silver. Each panel uses approximately 20 grams. Global solar capacity is expanding at double-digit rates annually. Electric vehicles use significantly more silver than internal combustion vehicles. 5G infrastructure, defense systems, medical applications. The industrial consumption list is extensive and growing. Current projections suggest silver supply deficits exceeding 200 million ounces annually by 2025. That's not a forecast of what might happen in a crisis. That's the baseline scenario assuming normal economic activity. Yet silver prices haven't exploded. Why? Because industrial demand is predictable and slow moving. The real catalyst, the mechanism that sends silver into parabolic moves, is investment demand. And investment demand in silver remains modest compared to its 2011 peak. But here's what's changing. The gold-silver ratio, the price of gold divided by the price of silver, currently sits near 88. 1. Historical mean over centuries, approximately 60. 1. When monetary stress drives investment capital toward precious metals, silver tends to outperform gold dramatically as the ratio compresses. This isn't mysticism, it's supply reality meeting monetary demand. Above-ground investable silver inventory is estimated at less than 2 billion ounces globally. That's roughly $60 billion worth at current prices. For context, that's less than the market capitalization of a single large technology company. It's a rounding error in global bond markets. It's 2 weeks of U.S. Treasury issuance. When investment capital decides silver is a monetary hedge, when even a small percentage of portfolio allocations shift toward physical metal, the available supply cannot absorb demand at current price levels. The market knows this, which is why silver has been holding support levels that should have broken during normal deleveraging cycles. Someone is accumulating, quietly, patiently, before the narrative shifts. The counterparty-free advantage. Here's the fundamental distinction that separates precious metals from every other asset class during sovereign debt stress. Gold and silver are not someone else. Is liability. A bond is a promise to repay. A currency is a claim on future economic output. A stock is a share in a leveraged enterprise. Real estate depends on property law enforcement and tax regimes. Even cryptocurrency relies on network integrity and regulatory tolerance. Gold is gold. Silver is silver. They exist physically. They require no counterparty performance. They don't depend on judicial systems honoring contracts or governments respecting property rights. In stable times, this distinction seems philosophical. In unstable times, it becomes the only distinction that matters. Portfolio managers tasked with preserving capital across regime changes recognize this, which is why allocation models are quietly shifting from 0.02% precious metals, the token allocation that wealth managers recommended for decades, toward 5 to 10% positions that reflect actual concern about monetary stability. This isn't fear, this is arithmetic. When sovereign debt reaches levels that cannot be serviced without monetary expansion, when term premiums reprice across developed markets, when the tools available to policymakers all involve currency debasement in one form or another, precious metals aren't speculating on collapse, they're responding to the mathematical certainty of what comes next. The bond market is repricing sovereignty, and gold and silver are repricing the value of assets that exist outside that system entirely. The professionals already understand this. The question is, how long before the broader market catches up? Every debt crisis in history resolved through one of three mechanisms. The names change, the political rhetoric shifts. The technical details differ across centuries and continents, but the underlying mathematics always force the same fundamental choices. And understanding which pathway unfolds, understanding the signals that indicate direction before the mainstream recognizes the shift, separates those who preserve capital from those who watch it evaporate in real terms. Right now, global policymakers stand at a crossroads they publicly deny exists. The debt accumulation of the past 15 years has created a situation where all available options carry profound consequences. There is no painless exit. There is no return to the stability of previous decades. There's only the choice of which pain to accept. Let's examine each pathway with clarity, because the investment implications differ dramatically depending on which route governments and central banks ultimately take. Pathway 1, the orderly repricing. This is the scenario that appears in official forecasts and central bank projections. It's the one policymakers hope for publicly and pray for privately. In this pathway, bond yields rise gradually over years. Governments respond with modest fiscal adjustments. Spending growth slows. Tax revenues increase as economic activity expands. Deficits decline from extreme levels to merely elevated levels. Markets adjust to higher interest rates without systemic breakdown. It sounds reasonable. It's appeared in IMF reports and OECD forecasts for over a decade. And it has never actually happened. Why? Because orderly repricing requires political will that democracies rarely summon until crisis forces action. It requires telling constituents that promised benefits will be reduced, that tax burdens will increase, that the standard of living must adjust downward to match economic reality. Politicians who campaign on austerity lose elections, which means austerity only arrives after markets force it, at which point it's no longer orderly. But let's assume for analysis purposes that this pathway somehow materializes. What happens to precious metals? Gold and silver advance steadily but without explosive moves. Perhaps 10-15% annually as real interest rates remain slightly negative and currency debasement proceeds at controlled rates. Institutional allocations increase modestly. Volatility remains elevated but manageable. For business owners and investors, this scenario allows time to adjust. Refinancing can be planned in advance. Capital allocation shifts can happen deliberately. Portfolio rebalancing occurs over quarters rather than days. This is the best case scenario. It's also the least likely. Pathway 2, the disorderly liquidation. Event history provides numerous examples of this pathway. The UK gilt crisis of 2022, the European sovereign debt crisis of 2010-2012, the emerging market contagions of 1997-1998. In this scenario, bond markets lose confidence suddenly rather than gradually. An auction fails to clear at expected yields. A major institution reveals unexpected losses. A political event triggers reassessment of fiscal credibility. The initial shock appears contained. Officials issue reassuring statements. Then the contagion mechanism activates. Hedge funds holding leveraged positions face margin calls. Forced selling in one market cascades to others. Volatility spikes trigger algorithmic deleveraging. Pension funds scramble to meet collateral requirements. Insurance companies liquidate assets to cover liabilities suddenly marked down. Central banks recognize the systemic threat within days. Emergency measures get announced. Liquidity facilities activate. Yield curve control gets implemented. Balance sheets expand dramatically. The language used is always the same: maintaining market functioning, ensuring financial stability, temporary measures to address technical conditions. The effect is monetary expansion by another name. In this pathway, precious metals experience extreme volatility, sharp initial drops as liquidation forces selling across all assets. Then explosive rallies as the policy response becomes clear. Gold potentially moving 30-50% within months. silver potentially doubling as investment demand overwhelms available supply. This pathway creates opportunity for those positioned in advance, and devastation for those caught unprepared. The speed of the move, the violence of the repricing, rewards those holding physical metal before the crisis, rather than attempting to acquire it during panic. Business implications are severe. Credit availability tightens overnight. Refinancing windows narrow. Operating capital becomes expensive or unavailable. Companies with strong balance sheets survive. Over-leveraged enterprises fail regardless of operational quality. This pathway is significantly more likely than orderly repricing, but less likely than the third option. Pathway 3, the financial repression regime. This is the pathway that combines the worst elements of both prior scenarios while maintaining a veneer of stability that deceives casual observers. Financial repression occurs when governments deliberately keep interest rates below inflation rates, allowing debt to be eroded in real terms while maintaining nominal stability. It happened in the United States from 1945 to 1980. It happened in Japan for decades. It's happening now across developed markets, hidden behind technical language and inflation measurements that systematically understate price increases. Here's how it works in practice. Official inflation runs at 4 to 5% annually. Central banks keep policy rates at 3 to 4%. Bond yields are suppressed through various mechanisms: quantitative easing, regulatory pressure on banks to hold government debt, pension requirements, capital controls. Savers lose purchasing power steadily. Anyone holding cash or conventional bonds gets quietly impoverished, but there's no dramatic crisis, no bank failures, no emergency measures. Just a slow, steady transfer of wealth from creditors to debtors, with the government as the largest debtor. This pathway allows governments to service nominal debt obligations while inflating away the real burden. It's politically palatable because the damage is distributed over years rather than concentrated in crisis moments. Most people don't notice they're being impoverished until the erosion is substantial. For precious metals, this is the optimal environment. Gold and silver enter sustained bull markets that last years or decades, not because of fear, because they're the only major asset classes offering protection against systematic purchasing power erosion. Historical precedent. Gold rose from $35 per ounce in 1970 to $850 in 1980. Not because the economy collapsed, but because real interest rates stayed deeply negative throughout the decade. Silver moved from $1.50 to $50 in the same period. A 30-fold increase driven by investors, recognizing that holding currency guaranteed wealth destruction. In this pathway, annual returns of 15-25% for gold and potentially higher for silver become reasonable base case expectations, rather than optimistic speculation. Not every year, not in straight lines. But the trend persists because the underlying driver, negative real rates and currency debasement, persists. Business implications require strategic adjustment. Cash becomes a wasting asset to be minimized. Debt at fixed rates becomes advantageous if used productively. Hard assets, real estate, commodities, equipment, precious metals, outperform financial assets. Reading the signals. The critical question becomes, which pathway are we on? The answer reveals itself through observable indicators that update continuously. Watch bond auction results. Strong auctions with tight bid-to-cover ratios suggest orderly repricing remains possible. Weak auctions with high tail yields signal markets losing confidence. Watch central bank language. When officials emphasize data dependency and gradual adjustment, orderly repricing is the goal. When language shifts to flexibility and market functioning, disorderly events are being anticipated. Watch credit spreads. When corporate borrowing costs rise faster than sovereign yields, stress is building in the system. When spreads compress despite rising rates, financial repression mechanisms are activating. Watch currency volatility. Stable foreign exchange markets suggest confidence in policy coordination. Violent currency swings indicate capital flight and loss of faith in monetary management. And watch precious metals themselves. How quickly do pullbacks get bought? When gold dips 3-5%, does it languish or recover swiftly? Swift recoveries indicate strong underlying demand waiting for entry points. When silver experiences volatility, does it collapse through support or find buyers immediately? Persistent buying pressure suggests accumulation by informed capital. The strategic framework. For business leaders and serious investors, positioning requires clarity on 3 dimensions. First, time horizon. Short-term speculators will be shaken out by volatility regardless of ultimate direction. Precious metals positioning makes sense for capital that won't be needed for years, not months. Second, allocation size. Position sizing should reflect consequence of being right versus consequence of being wrong. If sovereign debt reprices and currencies debase, what percentage of portfolio in precious metals preserves purchasing power? If the system muddles through, what allocation in metals represents acceptable opportunity cost? Most institutional analysis suggests 10% in precious metals provides meaningful protection without excessive concentration. Individual circumstances vary, but zero allocation represents a conscious bet that monetary stability continues indefinitely. Third, physical versus paper. In orderly repricing scenarios, gold and silver ETFs function adequately. In disorderly scenarios, counterparty risk in paper contracts becomes relevant. Physical metal and secure storage eliminates that dependency. The mathematics haven't changed. The debt exists. The servicing costs are rising. The policy tools available all involve monetary expansion in one form or another. Gold and silver aren't predicting doom. They're responding rationally to incentive structures that favor currency creation over fiscal discipline. The question isn't whether precious metals belong in strategic portfolios. The question is whether investors position before the broader market recognizes that the regime has already shifted, or whether they wait for confirmation that arrives only after substantial repricing has occurred. The bond market is asking questions it hasn't asked in decades, and precious metals are providing answers before the questions become headlines. The professionals are positioned. The question is, are you?